What I say though, in a general sense, so I won't talk about a specific company or whatever. When you're evaluating an investment company that's raising money, you need to look for a few things. You need to look for the company's pipeline. You need to look for the company's exits. What have they executed an exit so far? Because remember, you know, the bulk of your return, especially in PE and real estate and certain asset class, depends on the strategy you have. But let's use PE as an example.
Private equity.
Yeah, private equity in this instance now. Bulk of your return is from the exit. So what is the exit history? How have your exits panned out? Were they successful? Did they generate the return? Correct. Did they generate the return that you need, etc.? And then you need to balance the discussion around pipeline, what is to come, exits, what has gone already, and what you're doing now to add value. Are you a passive investor? So do you just allow management to do their job? Or are you one of the co-managers of the assets in your portfolio? And then lastly, you need to watch the management fee to see if you're in line with peers. Are you charging more money? Are you more expensive? Are you on assets or are you on book value? Stuff like that. So whenever you're evaluating any fund, as a matter of fact, any fund, you need to look at those things. And if you're missing those things, you're gonna have issues.
You're gonna have issues. At a way cheaper price.
You're gonna have issues.
Discount.
You're gonna have issues. Personally, I would not touch an investment vehicle that doesn't speak to exits and doesn't speak to a pipeline. I mean, I can see stuff around strategy and sector and fees, but those are the two main channels that investors are interested in, because that's how I can gauge how much risk I'm taking.
Exactly.
Do you also think it's the price to get it at though? Because like you would be willing to do something like that. It's just for that you have to give me a wicked discount that justifies or kind of bakes that in.
You mean to address just the transparency?
Yeah. Well, no, just saying like, for example, like, okay, there's a company where say they haven't exited an investment yet. Say the management fees are kind of high, but it's like almost the price that they're giving you at kind of justifies that risk, I guess. So that they're giving you a very heavy discount on something like that to the point where it's like, okay, yeah, it's not the best, but it's like, okay, just giving me that cheap.
I was being generous, so I'll add something else. Let us say this is your third fund, right? You're on your third fund and you don't have any exits and you don't show me a pipeline and you're coming to the market. That's one thing. It's your third fund. You can be a first-time fund manager with no exits and you're not showing me a pipeline. I don't care what price you're coming with. I'm not doing that. That's me.
Yeah.
I am not doing that. Now, I do agree philosophically that there should be a discount, but how do you value that? You've never done a discount. This is your first fund. I don't see no pipeline. I mean, what do I have to work with? I don't have anything to work with. I don't have anything to work with. You know?
Yeah, and then just the whole thing around transparency too, because you also want to show what have you done even recently, like in the past year, you know. And as an investor, if I'm going to buy into this, whatever investments it is, whatever company, it doesn't even have to be you know, PE or anything, but I want to see some recent stuff, like what have you done this year? It's 2025 now. Tell me about the year.
Recent financials, you mean?
Recent financials, you know. Tell me how the year went. The financials you're putting forward can't be from 2024. That's old. We're almost in 2026 now. You get me? So show me something of this year, even if it's the first 2 months, or first 6 months, of the year, right? Like from January to June. Show me something. But
well, you know, just to balance the discussion though, because again, remember, I'm a villain, so I have a lot of persons who misconstrue stuff. I speak directly. Like, even though we're having a broad discussion, I speak directly about a company like Dequity. Dequity is needed. You need companies that are set up to take risk in small and medium-sized enterprises in the Caribbean. It's a big problem. They're needed. And not just that, but when you have situations where these vehicles will come to market and don't get to raise the money, you create negative precedents. So the next time this happens, they'll point to it and be like, well, this didn't work out, so blah, 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 whatever. So now the next person who comes with an investment holding company in the Caribbean doing a PE strategy, even if it's different sectors, they have the pipeline, they have the exits, they have all these different things, bells and whistles. It still have negative precedent. Well, that never worked, blah, 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 whatever.
So they have to come with something good.
Yeah. The discount will likely be bigger. They're really going to have to, pull the rabbit out of the hat. But just to be clear, it's needed. Yeah, it's needed though. It's needed. Equity is needed, and I want to see what equity comes with in the future. So I don't want.
I know Mears is gonna come back again, and
for
it's
sure.
Be a sweeter deal.
Yeah, I know Mears. I know him. He's not my friend to say, boy, we'll par and drink rum, but he's a guy I know. And we see each other, we'll talk and whatever. And I just don't want our discussion to be misconstrued. We want Mears to succeed. I think he's going to succeed. And I know how he is. He takes these things very hard. So just wait. I don't know. Probably just double the size of Dequity and come back.
Yeah.
So let's see.